Hi there, in this video, I'm going to start a new topic. If you remember, in the previous 2 weeks, we talked about partnership. In the first chapter, we start talking about the beginning of the partnership, the distribution of income, and then in the last chapter, we talk about the termination and liquidation of partnership, where we talked about the journal entries and the capital accounts, the safe payments, and the pre-distribution plan that the accountant can create at the liquidation and termination of partnership. But starting from this chapter and almost till the end of the semester, we will talk about the corporations. And the first chapter here, which is, although it's module 3 in week 3, but in the textbook, you will see the material I am presenting in this video in chapter 1. And it talks about the equity method for accounting for investment. And what do I mean by equity method? I mean when one company is buying shares in another company. The company that buys the share, we call it the parent company. And the company that sold the shares, we call it subsidiary company. And here in the whole chapter, we will talk from the parent company side. If the parent company is acquiring less than 20% of shares from the subsidiary company, the parent company can use the fair value or the cost method in making their journal entries. And I'm going to show you how to make the journal entries based on fair value or cost method. If the company or the parent company acquires between 20 and 50%, this one we call it significant influence on the subsidiary company. And here they use a new method in recording, we call it equity method. And there is a huge difference between fair value method and equity method. If the company owns more than 50% in the subsidiary, here we don't make journal entries, but we make consolidated financial statements where it shows the parent company financial statement and the subsidiary company financial statement and their total together statements. We are not going to discuss the consolidated financial statement in this chapter, but we will discuss it in the future. But in this chapter, we will focus on fair value and equity method. So let us talk about the fair value because it's simple. We assume here a company by the name of Bob. It buys 2,000 shares from Sun, and Sun here, it's the subsidiary company for $50,000. And it doesn't have any influence. So if the parent company doesn't have any influence on the subsidiary, we can use the fair value method or the cost method. What is the journal entry we should make when we do that? We debit investment in subsidiary company. And here the company name is Sun, so we call it investment in Sun. But if I have another name, I'm going to change Sun by the other name. And we credit cash. Again, this journal is made by the parent company, not the subsidiary. Why? Because the parent company purchased the shares from the stock market. So the subsidiary company doesn't need to worry about who is buying their shares in the stock market. But the parent company cares about it and they put it in their record. And here you can see it's a plus A. It means the assets of the parent company will increase. And this investment in Sun, it will go on assets. If it's investment for more than a year, we put it under long-term assets. If it's less than a year, we put it under short-term assets. But the cash will be credit, so here the assets will be decreased as well. Yes, the net change in the assets will be 0 because plus will offset the minus, but you need to make the journal. Then, at the end of a certain period, the parent company receives $4,000 in dividends. So how can we record it? We debit cash by the dividends amount, and we credit dividend income by the amount. So Here we put 2,000, I'm sorry, this should be 4,000. So here I made an error. It should be 4,000, the amount of dividends they received. Now, how can we make the equity method? In the equity method, we do the purchase of a stock same as the fair value method, where we debit investment in subsidiary, credit cash. But these two journals about net income and dividends are different from the fair value, because in the fair value, we don't recognize the net income, but we recognize the dividends only. So if we have significant ownership and significant influence between 20% and 50%, then we must use this journal of net income. We debit investment in subsidiary, credit equity in investment income, and here by the portion of the net income that has been assigned by the subsidiary and allocated by the parent company. And I'm going to show you several examples to show you how to make this journal, but you need to be aware that if the subsidiary disclosed net income, the parent company has to record their portion of net income by debiting investment in subsidiary, same as the purchase, and credit equity in investee income. We know from the previous slide that those accounts are assets, but the equity in investee income is going to be revenue that will go to the income statement. Then the subsidiary will declare dividends. So here we debit dividends receivable, credit investment in subsidiary. It means our asset account here has been decreased by the dividends. We didn't do this journal in the fair value method, but we do it here because the parent company has significant ownership and must disclose the dividends once it's declared. When the dividends is paid, we debit cash and credit dividends receivable. So you can tell from those two slides that the fair value is different from the equity value. The fair value is being used if the parent owns less than 20%. The equity is used if the parent company owns between 20 and 50. And you don't need to memorize these percentages, but it will be mentioned in the example. And let us look at the first exercise. So here we say Puma Incorporation acquired 10%. So we know that 10% is not significant of Sunny, and this is the name of the subsidiary company, on January 1st, 2020, for $183,000 and appropriately accounted for the investment using fair value. So here the exercise is telling you which method that you should be used in answering the exercise. Then on the next year, on January 1st, 21, Puma purchased an additional 30% of Sunny. So now Puma increased the ownership from 10 to 40. That can tells you that now it became significant influence, and now we have to change our method from fair value to equity method. So on that day, the fair value of Sunny common stock became $2,020,000, and the book value became $1,870,000. It means the market price of the subsidiary company has been increased in general in the stock market. This is for the 100% of the shares. The Puma, which is the parent company, owns only 40%. So we have to recognize the difference in the market price only for the 40% that we own. And then the land was undervalued by 136. And now there is an additional excess fair value over Sunny book value, but was attributed to a trademark. So for this change that happens in the common stock and the land, they recognize it as trademark with 8-year remaining life, which means we take this difference divided by 8 years to get the amount that should be allocated in year 2021. And then Sunny reported net income. So we need to take our portion of that net income and the dividends as well. So what do we need to do in this exercise? We need to make only journal entries in 2021, which means we don't need to make the first journal here in 2020. If you do it, that's fine. If you didn't do it, it didn't ask about it in the exercise. So let's start. So for the first one, this is the amount of a stock that we purchased in 2021. So we debit investment in Sunny, credit cash. Then the Sunny declared net income 315. We take only 40% because our ownership 10% from last year plus 30% this year makes 40%. And here we debit again investment in Sunny, credit equity in investee in. Then we get also our portion of dividends, which is 40% from 106, and we debit dividends receivable, credit investment in Sunny. And then the same amount has been collected, so we debit cash, credit dividends receivable. So this shows you in brief how to make the journal entries under fair value and under equity method. In the next video, I'm going to show you more exercises. Thank you. Bye.